FinCEN, Residential Real Estate Reporting Rule. So quickly, before we get started, I do want to announce that we have launched a FinCEN hub in our AgentNet Knowledge as a go-to resource for information, which Judicial is able to access. So if you do have any questions, we have a very extensive database for FinCEN, for forms, bulletins, and any changes in rules. And again, Judicial will be an important connection for you in the coming weeks and months in regards to FinCEN. All right, so let's talk about our agenda. Again, welcome everyone listening. I'm very happy you are all here to learn about this new and important rule. And as you can see, we do have a lot to get through today. We're going to start with a quick history recap of how we got here from where it started. And then we're going to really get into the rule and discuss what the rule covers in detail, hopefully by the end of the presentation if I have time, and really give you a better understanding of what the government is looking for and how to give it to them. So let's get started. All right, how did we get here? Well, I think to appreciate the significance of this real estate reporting rule, which we're going to refer to as RRE from now on, or probably the rule is what I'm going to refer to it as. It's essential to really understand the history and evolution of anti-money laundering laws in the United States as a whole. The Bank Secrecy Act is important, the BSA, which was enacted in 1970 and then strengthened by subsequent laws like the Patriot Act. They established the foundation for financial transparency and reporting obligations to detect and, more importantly, deter money laundering. Over the decades, these laws have been expanded in scope to cover a wider range of topics in financial institutions and transactions. So this new rule is the latest development in a 55-year evolution of AML, or anti-money laundering laws, in the United States. So before we get into this new rule, let's begin with the brief history, as I said. I'm a big movie person, and I'm sure a lot of you have seen The Godfather 2, Part 2, and preferably my favorite one of them. So if you're a fan of this movie, or if you're not, you might recall when crime boss Michael Corleone, who played by Al Pacino, testifies before Congress. It's a really big, important scene, and that was actually inspired by real events in the late 1960s. So Congress held a bunch of hearings into organized crime. And the point of this was to expose the extent to which organized crime exploited anonymous financial transactions to conceal illicit profits, and ultimately led to the passage of the BSA to improve financial transparency and aid law enforcement. The BSA was the first comprehensive framework for combating money laundering in the United States. It required financial institutions to assist government agencies in detecting and preventing financial crimes. Its key provisions included mandatory record keeping and reporting requirements for certain types of transactions. Most notably, the Current Transaction Report, or the CTR, which requires banks to file reports for any cash transactions exceeding $10,000. This is a popular one where everybody likes to say, oh, if you put $9,999, the bank doesn't report it. As we see, there are ways that the bank combats that as well, but this is one of the more well-known rules in banking for lay people. The BSA also required banks to maintain records of customer identities and transactions that could be useful in criminal, tax, or regulatory investigations. By imposing these obligations, the BSA aimed to create a paper trail that law enforcement that could then use to uncover patterns of illicit activity, disrupt organized crime networks, and enhance the federal government's ability to track movement of funds throughout the United States financial system. But unfortunately, the BSA sat largely dormant for about 15 years until 1985, when First National Bank of Boston pleaded guilty to willfully failing to comply with the BSA by not reporting more than $1 billion in reportable cash transactions. The case exposed the weakness of existing financial regulations and spurred Congress to enact stronger and anti-money laundering legislation. Then in 1986, Congress passed the Money Laundering Control Act, or MLCA, which established money laundering as a federal crime. Prior to that, it wasn't. And the concept of a BSA AML program by directing banks to maintain policies and procedures to monitor BSA compliance. The MLCA also prohibited structure which is engaging in transactions just below that $10,000 limit to evade the CTR filing. So filing a $9,999 check multiple times. It also introduced civil and criminal forfeiture for BSA violations. And despite the passage of this, Congress still remained concerned about the bank's permissive approach to money laundering prevention. The threat was particularly acute in the 1980s and early 90s with the rise of transactional drug cartels. They were trying to add the teeth, but they still were missing it, is the main point. The clearest example of this threat was embodied by the Bank of Credit and Commerce Institution, which was a global bank with U.S. operations that allegedly banked Iraqi dictator Saddam Hussein, Panamanian dictator Manuel Noriega, and most famously, the Medellin cartel, among other criminals. The bank was subject to a salacious U.S. Senate Foreign Relations Committee report detailing the bank's involvement in money laundering, bribery of foreign officials, arms trafficking, and even the sale of nuclear technology. The bank was then liquidated in 1991 after criminal investigations shed light to the full extent of the fraud, manipulation, and money laundering that the bank was a part of. In wake of this scandal, Congress passed the Annunzio Weil Anti-Money Laundering Act of 1992 that required banks to file suspicious activity reports, or SARs, and enabled regulators to terminate federal deposit insurance and even revoke charters of banks convicted of criminal money laundering. So while these AML advancements continued through the 90s and 2000, bank regulators and the industry discussed potential rollbacks in the BSA and AML requirements. However, those reforms were forever tabled as of September 2001. The terrorist attacks of September 11, 2001 prompted Congress to enact the USA Patriot Act, which I'm sure we've all heard of. This dramatically expanded the scope and rigor of American AML laws. And Title III of the Act, the International Money Laundering Abatement and Financial Anti-Terrorism Act, introduced some of the most significant far-reaching changes to the AML and counter-terrorist financing framework since the enactment of the original BSA. Specifically, the USA Patriot Act criminalized terrorism financing. It strengthened customer identification procedures. It prohibited financial institutions from dealing with foreign shell banks, as they're called, and it required enhanced due diligence for certain accounts. Before the Patriot Act, the BSA focused on money laundering from crimes like drug trafficking, fraud, think the mafia and the cartels. The act made counter-terrorist financing the central goal of the BSA. It required institutions to identify and disrupt the movement of funds tied to terrorist organizations and monitor foreign and domestic transactions more rigorously. And you'll always hear about the terrorist list. And when you get on that, you get on this equally difficult BSA monitoring sheet. So one of the more significant overhauls of the BSA AML regime since the Patriot Act came with the AML Act of 2020. So AMLA's 2020 central theme was security through transparency. It introduced the Corporate Transparency Act, or the CTA, which required corporations, limited liability companies, and similar entities to report beneficial ownership information to FinCEN. While the CTA's implementation has been subject to delays and litigation, its intent has been clear. It's to pierce the veil that of anonymity that shields illicit actors in the financial system. So you have certainly heard things about the CTA's beneficial ownership information rule. It's often confused with this new rule that we're going to go over. A lot of times people think it's already implemented. The CTA BOI rule requiring corporations to report beneficial ownership information to FinCEN when the companies were formed. The idea being that there would be a registry of BOI information that is kept up by FinCEN. So the Trump administration did do away with this requirement for domestic companies. So domestic companies don't have to do the reporting anymore, and it only applies to foreign companies. I call this out because of the confusion between the two rules. The CTA BOI rule was and completely separate from this new residential real estate reporting rule that's going into effect March 1. Okay, so going back just a little bit, talking about FinCEN. So in April 1990, between the passage of many of these acts, the Treasury Department established the Financial Crimes Enforcement Network, better known as FinCEN, and who we're going to be talking a lot about today, to safeguard the financial system from illicit use, combat money laundering, and promote national security concerns. So FinCEN's role has really expanded since the 90s. The security of the Treasury delegated administration of the BSA to FinCEN, which is now the official bureau of the Treasury Department. And FinCEN's scope is it's vast. I'll say it, at the very least. The Bureau is responsible for collecting and analyzing financial data such as the SARs, the CTRs from financial institutions, and it maintains the world's largest financial crime intelligence database. People go to them for information. Along with other regulators like the Office of the Comptroller of Currency, FinCEN regulates and enforces the BSA to ensure financial institutions comply with AML laws. It also serves as the United States Financial Intelligence Unit, which collaborates with domestic and international agencies as well. FinCEN is arguably the largest financial crime intelligence database in the world, and with this new rule, the database is only going to grow larger. SARs are highly confidential and treated the same way as a confidential informant for evidentiary purposes. Though the rulemaking authority delegated to FinCEN pursuant to the BSA and its progeny statutes, FinCEN's jurisdiction has expanded over time. As Rich said, right now we're used to the 5 boroughs. That's going to expand vastly. FinCEN can bring enforcement actions such as imposing fines or penalties against banks, casinos, money service businesses, cryptocurrency exchanges, and others that may violate anti-money laundering rules. Now, the statutory history is important, but the RRE's rules' true origin rest in the history of FinCEN's GTOs, or geographic targeting orders. The GTOs have been temporary orders that impose additional reporting requirements on financial institutions. They typically last about 180 days, but they've been subject to renewal, and every time they've been about to expire, there's been a new GTO. FinCEN first issued a GTO in 1996, subjecting money remitter agents in New York City to report remittances of cash to Colombia of $750 or more. This was a significant expansion of BSA enforcement to the non-bank financial sector and set a precedent for real estate GTOs. At the time of the first GTO, the FinCEN director, Stanley Morris, stated, quote, "Based on the success of the GTO and the analysis of FinCEN in conducting in cooperation with other law enforcement agencies, it is clear that we need to consider other applications of geographical targeting orders, as well as broader, more permanent regulatory steps to address vulnerabilities in the money remitter industry." And in January 2016, FinCEN took that step and began using GTOs to target all cash luxury real estate purchases in New York and Miami. The 2016 GTO followed a multi-series expose by the New York Times entitled "The Towers of Secrecy," which documented how criminals, kleptocrats, and corrupt officials were buying millions of dollars in U.S. Real estate anonymously. FinCEN has repeatedly renewed and expanded the real estate GTOs to include certain counties and most major metropolitan areas across 14 states, which the purchase price threshold of $300,000, which I'm sure you know in the 5 boroughs, that's probably going to cover any cash transaction. FinCEN's most recently renewed the GTO on April 14th, 2025, effective through February 18th, 2026. Excuse me. The expansion of GTO authorities brings us to the present day, which is the enactment of the residential real estate reporting rule. So this slide is here to show the expansion of GTO just through November of 2020. You can see here that the monetary threshold went from $3 million all the way down to $300,000. Counties have been added. So starting off in 2016, we had Manhattan and just Miami-Dade, then Brooklyn, Queens, Bronx, Staten Island, Broward, Palm Beach. Honolulu made its list in 2018. Then Texas, Nevada, Washington, Massachusetts, and Illinois were added in 2018-2019. All were $300,000 thresholds except Baltimore City, which was at $50,000, and that was because Baltimore has row houses that are relatively inexpensive that FinCEN thought were being ripe for money laundering, is the assumption and guess. So According to FinCEN, the GTOs have continued to provide valuable data on the purchase of residential real estate by individuals who may be involved in money laundering and other illegal activities. Again, according to FinCEN, GTO reports are shared with law enforcement agencies and been proven to be a powerful tool in tracking and disrupting networks involved in drug trafficking and money laundering. The renewed GTOs have served as a testing ground. The insights gained from these efforts directly inform the new rule that we're now going to be discussing and getting into. All right, so let's get into the new rule, the RRE rule, which seeks to increase, again, transparency in all cash real estate transactions by requiring certain professionals to report information, including the identities of beneficial owners behind purchases, with the hope being preventing money laundering through anonymous property deals. Okay, so the rule is effective for transactions nationwide. There's no longer certain states, certain counties. It's going to be a nationwide blanketed rule. There's no more limiting to certain states and counties, and that close in on or after March 1st, 2026. So closing day here, that's one of the important things to know, is defined in the rule as when ownership interest is received in the property. So I think it's safe to say it's just the traditional closing date on the property. Things you need to think about now, or what about files that are open now, deals you're working on right now, but they be reportable if they close after March on or after March 1st, and they otherwise fall within the parameters of the rule. So certainly deals in January and February, you really need to start thinking about those. What needs to be reported? Okay. All non-finance cash transfers of residential real estate where the transferee is a trust, subject to exceptions and exemptions that we're going to talk about here in a little bit. Who has to report? Typically, it's going to be a settlement agent, but there are 7 different categories of reporting people, and there is a designation agreement that can shift reporting responsibilities in that structure, which we're going to discuss in a little bit as well. So why do I say it's typically the agent? Well, that's because they're first on the list of 7 reporting persons, and that's the settlement agent who have to report. And we're going to get into reporting responsibilities in a little bit as well. So when to report? The reporting can be done later of the last day of the month following closing, or 30 calendar days after closing. And then finally, how do you report? You're going to report electronically using a real estate report form that is filed on the FinCEN BSA e-filing system. The form has been finalized, and FinCEN is providing the final report form, which again is through our website. I believe it's through Google as well. And I think we're fairly confident about the information that we're going to need to provide. I don't think we're going to see any changes from the proposed rule. The proposed rule included all the information that FinCEN wanted to see. This presentation is going to talk about all that information that needs to be reported on the form. There are 111 separate items of information that could possibly be needed through that form. Again, don't panic at that number. It's probably going to be less for each transaction, but it still is a lot of information, and we're going to talk about all of that. All right. So what is a covered transaction? What are they? A covered transaction is a non-financial transaction of residential real estate to entities or trusts. That is because FinCEN has identified these types of transactions as high risk for money laundering, and because the GTOs have provided that information to FinCEN on these types of transactions. The rule targets all cash transactions or transactions using non-institutional lenders. You're going to recall that the GTOs had a threshold of $300,000, except for Baltimore, which was 50. Well, that's all out the window now. There is no minimum threshold to report anymore. If your transaction meets all of the other criteria, a transfer for no consideration will be reportable under this rule. If you're familiar with the GTOs where we don't currently have to report trusts, you'll notice that this rule does add trusts. Trust for the subject of GTOs for a short time. 1 or 2 of the GTOs did say trusts were involved, but that was quickly removed. However, they did prove overly burdensome to FinCEN at the time, and they weren't providing the information they were looking for. So FinCEN eliminated them going forward for the GTOs, but they're bringing them back with this new rule. Okay, The rule contains a very, very, very broad definition for residential real property. It's defined into four ways. One is real property located in the United States that includes a structure designed principally for the occupancy by 1 to 4 families. So, pretty obvious what the examples are for this. I think there's a lot of other examples that could come up for this definition that maybe were not included previously. So, how about a mobile or manufactured home on vacant land where the customer asks for a mobile home to be affixed as part of the transaction? I think this could qualify for sure. How about a mobile home that's not affixed? It's still a property that includes a structure. So, again, I think it probably could fall under that. All of this is going to be really fact specific. So there's lots of examples that I'm sure you could think of, but if you're not sure and you're in that gray area, reach out to Judicial and we can have a discussion about it. Number two is vacant land with the intent to build. So, how? If the transferee intends to build, how do you know that? Well, I think you have to ask at this point. Is this something we've ever asked our clients or customers before? No, but it might be something we have to do from now on. Are you intending to build a residential structure on the vacant land? It's probably not something we've been asking before, but moving forward, if this transaction will meet the other criteria of the rule, I think we have to. Number three, there is a unit within a structure. So, apartment in a business, an apartment above a drugstore. It could be a single apartment inside of an apartment building. It doesn't have to be an apartment. I think there's lots of examples as well here that you can think of. And then number four, a share in a cooperative housing corporation. So co-ops. New York City, mostly, in some other larger cities, that's where you're going to see those. But again, it's a very broad definition of residential property. So now, what a covered transaction is, but let's break it down a little bit more. The definition of non-finance transfers is a transfer that does not involve an extension of credit to all transferees that is both secured by the transfer property and extended by financial institutions subject to AML program requirements and suspicious activity reporting obligations. The reason being, banks have to file these forms anyway. So if Chase is extending $100,000 on the property, they are going to be filling this out in a different way, meaning we don't have to fill it out. So if you have both of these things, if you have an extension of credit that is secured by the property, extended by financial institutions with AMLs, SAR obligations, it is not a reportable transaction. For a reportable transaction, we're talking about all cash transactions or transactions that are financed by an unregulated lender. So private lenders, hard money lenders, you're taking a loan from your family member, somewhere along those lines. All right, what if you have a partial payment in cash, but a loan form from a financial institution with an AML, SAR requirements? That's not going to be reportable as long as there is a loan from a financial institution with those obligations secured by the property. It won't be reportable. You can assume all due diligence is being done by the lender. Supposed to. Otherwise, they're subject to AML penalties, regardless of the loan amount. So it could be a $100,000 loan. It could be a $10 loan. How will you know if the financial institution is subject to AM or SAR requirements? Again, you might have to ask and confirm with the lender, or you can do some research. A lot of these lenders have their AML number on their website just to designate that they are compliant. Okay, so what else is different with this rule than GTOs is that it requires both the secured by the transfer property and extended by the financial institution. The secured by the transferee property was not in the GTOs originally. This was done purposefully by FinCEN. So here's an example of what they are trying to get at. If you have, for example, an iBuyer property investor who is accessing line of credit from a bank with AML and SAR obligations, the line of credit is not secured by the property. Without knowing the debt structure and the financing of the buyer, it's hard to tell. But I think you have to start with reportable on those types of transactions here. And again, these transactions are going to be very fact specific, and you could see a lot of different things. But for something like that, I think you have to start with reportable and maybe work your way back into non-reportable if you can get there. All right, this is the good part, in my opinion. What's excluded from exempted from being reported? Okay, easements, transfer of easements are excluded. Transfers pursuant to life events, so inheritances, divorce, transfer to a bankruptcy estate. Again, that makes sense because the federal government's got their fingers in that. Uh, that's all excluded. Transfers overseen by a court, those are excluded because, again, low likelihood of money laundering when the court is involved and there's court oversight. So judicial foreclosures, not reportable because, again, supervised by a court. Non-judicial foreclosures, not supervised, could be reportable. 1031 exchanges to a qualified intermediary, those are excluded. Transfers for no consideration made by an individual, either alone or with the individual spouse, to a trust of which that individual spouse, or both of them are settlers or grantors. Those are excluded. That is an important one that was added through push from the industry. Alta, land title associations were big on getting that rule added. That was not an original exclusion or exemption. And you could see why it deserves to be excluded and exempted. How much estate and family planning is done where people are going into their own trusts. Also excluded, but not on this slide, are transactions where there is no reporting person. So as I said, there's 7 reporting people. If you get to the 7th and that person is not in the transaction, it's not reportable. I am still yet to see somebody provide me an example of where there's not going to be a reporting person. So if you're listening here today and you're involved in a transaction, it's most likely going to need to be reported. If anybody does have that idea of where there is no reporting person, I would love to hear it. So please send that to me. But we're going to get all into the reporting person later. So let's talk about reporting purposes. Okay. Sticking with the exclusions and exemptions, let's talk about the exempted entities. So if the transferee entity is any of the following, it's exempt from reporting. Let's start with securities reporting issuers. So I have had questions about what is a securities reporting issuer. This is often referred to as a reporting company. It's a company that is legally required to file periodic reports with the SEC under the SEC Act of 1934. So these companies are typically public traded. So Google, I think, is the best one, First American, or they have issued securities in a way that triggers ongoing disclosure obligations themselves. So that eliminates the large public companies, but it doesn't eliminate private companies. It doesn't exempt someone who, let's say, has created an LLC, for example, and is using it to purchase property. In fact, that's exactly who FinCEN is looking for information from. All of these are exempt. Government authorities, banks, credit unions, public utilities, insurance companies, all of these are exempt, as well as any entity controlled or owned by an exempt company. So a wholly owned company that is exempt, that is owned by an exempt company, is exempt itself. So subsidiaries of any exempt companies are exempt. Okay, big one. Let's move on to trusts. What are the exempted trusts? If the transferee trust is any of the following: a securities reporting issuer, again, trust; a trustee that is a securities reporting issuer; a statutory trust. And the term statutory trust means any trust created or authorized under the Uniform Statutory Trust Act as enacted by a state and as defined within the rule. And then finally, just like entities, any subsidiary of an exempted trust is also exempted. Okay, so now let's go back. You've determined that this is a reportable transaction, doesn't fit any of those exemptions or exclusions. Let's move on to the meat of the rule here, the information that needs to be reported. The rule, excuse me, the rule requires reporting on much more information from many more parties than was required in the GTOs. I'm going to split this into 2 separate discussions. We're first going to talk about what we're going to call the basic type of information needed, and then separately the beneficial owner information. So first, the basic info that we need, both the transferor and the transferee, the buyer and the seller. We've never had to bother the seller before when it's been a subject of the GTO with getting their information, but that is going to change here. For both transferors and transferees, we need the name, address, and ID numbers. For transferee entities, that means we need the full legal name, the trade name or the doing business as, and the complete address. For addresses, that includes foreign addresses or foreign companies and a principal place of business in the United States for those foreign companies. If one exists and a unique ID number, that's usually going to be that IRS TIN number. And if there isn't one, then a tax ID from a foreign jurisdiction. And if there isn't one of those, then an entity registration number that is issued by a foreign jurisdiction. For transferee trusts, we want the full legal name, such as title of the agreement establishing the trust. So for me, the Tony Vozza Revocable Trust, dated such and such. And we need the date of the trust, instrument execution, and the ID number. And the IRS TIN or foreign tax ID number, again, going back to the previous paragraph. We can see how this can become an issue because many times we hear, oh, I don't know where my trust documents are anymore. Have to keep a hold of all that now. Should always have kept a hold of it, but now even more so. We need to report the same information if the transfer or the seller is an entity of trusts. I'm sorry, Diana, did I cut out?
Very briefly, not
Okay.
enough for me to mention.
All right. Thanks.
Thank you.
Sorry, everyone. We need to report the property details. So that is the legal description, an address if there is one, and that you need all the other transaction details as well. So that's the total consideration paid, all payment methods, date and transfer of closing date. Also need the name of any financial institution involved, the name of any and all players on the wire, check, or other type of payments. We need the information for any signing individual as well. Now, the signing individual is someone who you would traditionally think of as having general authority to sign for a company, like a vice president or a president or a manager or a CEO. For this rule, it's instead someone who has specifically signed as part of the reportable transfer. Again, for this person, we're going to need the same name, date of birth, and ID number. If it's an individual, you only have to report one signing individual if there is one. So if there isn't, then that's the information you don't have to get into. And finally, we have the beneficial ownership information. And we're going to go over that in the next few slides. But for these individuals, there are always going to be individuals. So you need to report their full legal name, date of birth, address, citizenship, and unique identifier number. So IRS, TIN, or tax ID issued by a foreign jurisdiction. Again, you're going to need all of that for the beneficial owners. So we're going to start talking about those now as well. And this is really what the rule is seeking to get at, the beneficial ownership information. They want to know who is ultimately going to be receiving funds. So we're going to start with the entities, corps, LLCs, or partnerships, or other similar business entities, So you can get the entity beneficial ownership information in one of two ways, an ownership threshold and substantial control. Meaning the ownership threshold is any individual owning or controlling either directly or indirectly 25% or more equity interests in an entity. So all of those persons have to be reported as beneficial owners. You also have to report anyone with substantial control over an entity. So in other words, those with authority over significant decisions. All right, what are significant decisions? The rule says it is someone who serves as a senior officer of the reporting entity or has authority over appointment or removal of senior officers, or has authority over appointment or removal of a majority of the board, or someone who directs, determines, or has substantial influence over important decisions or decisions over the assets of the company, expenditures, investments, compensation schemes, things like that. So again, you're looking at managers, presidents, CEOs, treasurers, people on the board, probably. I should also point out this rule does apply to nonprofits. For those, the beneficial owners are limited to those with substantial control, since there won't be any equity to own or control. Excuse me. Now, how about trusts? Well, all the following must be reported as beneficial owners of transferee trusts. Trustees, whether they are individuals or entities, if they are entities, you just have to do the same analysis that we just went through, 25% ownership or substantial control to get the individual beneficial owners. We need to report an individual other than a trustee with the authority to dispose of trust assets, what we call the trust protectors here. Then beneficiaries, of course, that makes sense. individuals who are the sole permissible recipient of income in principle from the trust, or who have a right to demand a distribution or withdraw the assets. And finally, any grantor or settlor with the right to revoke the transferee trust are considered reportable beneficial owners. All right. So that was all the information that needs to be reported. And again, it's a lot, and we're here to help. Now, who gets all of the fun of reporting that information? The reporting person for reportable transfers is a person engaged within the United States as a business in the provision of real estate closing and settlement services. That's the defined rule. There will only be one reporting person or business reporting. And again, what about that is a person or business or reports. If it's an employee, agent, or partner is reporting while acting within the scope of their individual's employment agency or partnership, then the individual's employer, principal, or partnership is deemed to be the reporting person. So one person or entity is the reporting partner. For example, if I'm reporting for a transaction for First American is deemed to be the reporting person, not Tony Vozza. The reporting person can be identified in one of two ways: by way of the reporting cascading hierarchy, or by way of written designation agreement between the real estate businesses described in the cascading reporting order that we'll get to in a second. Some may refer to as the cascading waterfall. That is the waterfall that goes from 1 to 7. Starting at number 1, if there's no more number 1, you go to number 2. So the entire waterfall, I've heard, again, other names for it, but waterfall is going to be the one I use, with 7 different functions a real estate professional may perform. And it determines who is going to be the initial reporting person all the way to the bottom. So we're going to start with the first function. And if there is no person involved in this transaction at that slot, you then move to the next, and so on down the line until you find someone. If there is no person, again, when you get to number 7, and it's highly unlikely in this group, and again, if you can think of a scenario, send it to me, then the transaction does not report. And by the way, once the reporting person is determined, there is more to report from there. We must report the information concerning the reporting person as well. And for that reporting person, you have to report the legal name, the category of reporting person, street address that is the reporting person's principal place of business in the United States. So again, if I was reporting on behalf of First American, it'd be First American. You would use the street address for First American's home office and their principal place of business. So here's what the hierarchy or cascade looks like. So we're going to start with the person listed on the closing or settlement statement as the closing settlement agent. For the majority of transactions, this is probably where you're going to fall, and you can stop. However, if that person doesn't exist, then we move on to the person that prepares the closing or settlement statement. If no such person is involved in that transaction, then the person that files the deed with the recorder's office, and that's a lot of times where the agent gets involved here in New York. After that, then the person that underwrites an owner's title insurance policy with respect to the transferred residential real property. Then the person that disperses in any form, including from an escrow account, a trust account, or a lawyer's trust account, the greatest amount of funds in connection with a residential real property transfer. If that person is not there, then we move to the person that provides the evaluation of the status of title. And then finally, the person that prepares the deed, or if no deed is involved, any other legal instrument that transfers ownership of the residential real property, including, with respect, shares in cooperative housing corporations, the person who prepares the stock certificate. If none of these people exist, again, then you're on the not reportable transaction side. Okay, now you don't necessarily have to be the reporting person if it falls on you in the hierarchy. And I think we're going to see a lot of these, which are designation agreements, which allow parties to designate specific individuals or entities to be the reporting person. The person who would otherwise be the reporting person must be a party to this agreement, and that they have to sign it. However, it is not necessary that all people involved in that transfer who are described in the reporting cascade be parties to the agreement. So you only need it between who is, let's say, number 1 and number 3. For instance, if the settlement agent wants to get into a designation agreement, and what's the title with the title evaluator to file for the particular transaction, even if it's numbers 2, 3, 4, and 5 are involved, only the settlement agent and the title evaluator have to be parties to the designation agreement. According to FinCEN, these designation agreements will allow for more flexible and efficiency in reporting. So again, designation agreements allow parties higher up in the hierarchy to designate someone lower in the hierarchy. Now, what if you want to move all your transactions to another party? So if we're talking about moving all of them under a blank agreement, there is an impediment to that in that a separate agreement is needed for each transaction. So you cannot have just a single blanket agreement that exists with a company for every transaction. Because when this rule was formed and proposed during the comment period, FinCEN got a lot of comments about people wanting blanket agreements. FinCEN did not allow for it. They said a single transfer could be subject to multiple potential overlapping blanket designation agreements between different parties, and in such a situation, it would be difficult for FinCEN to determine which person had ultimately responsibility for filing the report. So they want it to be clear in each transaction who filed. So you do need a separate designation agreement for each transaction. The record retention requirements are not many in this rule. One is that you need to keep a copy of all designation agreements for 5 years. We'll get to the other one in a minute. And also, if you have a designation agreement, you do not need to file that designation agreement as part of the real estate report. But you should keep it in your files in case FinCEN ever does come to do an audit and you want to be able to show. All right. There is no required format for designation agreements, but each separate agreement must be in writing, and it must include the date of the agreement, the name and address of the transferor, the name and address of the transferee entity or transferee trust, information identifying a transferred residential real property, and the name and address of the person designated through this agreement as a reporting person with respect to the transfer, and the name and address of all other parties to the agreement. FinCEN has said nothing else about what these designation agreements should look like. I'm sure we're going to see different versions. I'm sure everyone is going to have their own version of this, but there will not be any form agreement put out by FinCEN. Okay, so an important aspect of this rule also is the reasonable reliance standard. And that carries over from the GTOs, where we have to be able to rely on the information provided by third parties without having to do additional verification. This rule adopts a reasonable reliance standard that generally allows reporting persons, whether when reporting information required by the rule or when necessary to make a determination to comply with the rule, to be reasonably relied upon information that has been provided by other people. FinCEN believes that the adoption of this will significantly reduce the time needed to file the form compared to verifying the accuracy of each piece of information. They have said the estimated time to fill out this form is 2.5 hours, I believe. The commentary to this rule noted that the comments received to a rule can contain a lot of concern about verifying payment information, and FinCEN thinks this will relieve those concerns a little bit, and since there will be no independent verification necessary. So you are able to rely on info from others for required reporting information. You can also rely on information about whether a party is exempt from reporting. As long as there is no reason for you to question this reliability of the information, then there's no need for additional verification. So if you have a foreign company, you need to report its principal place of business in the US, and it tells you that there is no principal place of business in the US. But you work next door to what appears to be their principal business in the US. You probably should do a little more digging. I think as long as you don't know something to be false or there aren't additional inconsistencies in information given, you can rely on that information without any independent investigations. However, for BOI information,
I want to interrupt you for 1 second. I just want to give everyone the code. The course code is report. The course code is report.
Thank you, Diana. Okay, so for BOI information, though, or the beneficial ownership information, you can't just rely on and move on. For that 25% ownership or substantial control, you can rely on information you've been given without further investigation, but you have to get a certification in writing from the transferee or transferee's authorized representative. So we have Alta collection forms, which are also able to find in Agent Net Knowledge, which Judicial will be able to access. And for our FinCEN hub that we've talked about, this form was created by an Alta work group, and they take the guesswork out of it. They ask for certification of all information that you need to report on this rule, and there's a certification at the bottom that they need to sign. You can use them if you want. You don't have to use them. You can use your own forms, but I think this form that Alta created is very important and very great. Okay, so just to wrap up on the reasonable reliance practice due diligence, if you suspect you're being given false information or misleading info, do some further investigation. As for record keeping, the other requirement for record keeping purposes in this rule is to keep a copy of the certification of beneficial ownership details for 5 years. So that, along with the designation agreement, are the only two record keeping requirements in this rule. Personally, I would recommend, again, keeping everything having to do with this rule for at least 5 years, but those are the only two that they require. But like I said, not required by the rule, just something I think is good practice. Now, how do we file? First of all, for help collecting the information, you can use the Alta collection forms that I was just mentioning that have the built-in certification. There's one for both a buyer and the seller. You can also use your own form, web portals or other softwares, but you need to consider these things. When and how to send and collect from customers. The timing is important so you can get all the information before the required reporting period. How to ensure a timely return. You need to make sure you get these back timely so, again, you can file on time. Where and when and how are you going to store these completed forms? What will your quality control processes look like? Right now, the rule says that you won't allow any blanks for required information and that they won't allow incomplete reports. So you have to be sure you get it all, and that makes sense. And you have to make sure you have those attestations for the BOI information. The filing itself is done through a BSA e-filing system, and if you don't have them already, you're going to need to create your own login.gov account to access this system, and you'll need a BSA e-filing account. Once you're in the system, you can have a fillable form inside the system. You can upload a filled PDF or do a batch file on your own API. All right, so that is the rule, and now I want to take a few minutes to see what kind of volume we're talking about. So Mark Fleming is First American's chief economist, and he put together the next few slides, and I think they're very eye-opening for everyone. These figures were mined from the recorded public records nationwide, so this includes all transactions. This is not just First American. So this represents industry-wide numbers. These charts are looking at all cash residential home sales to legal entities or trusts. So this is going back throughout the years of what the volume would have been had this rule been in place. The left-hand side is the number of sales in the thousands. The right-hand side is the percentage of total sales, which is represented by the green line running through the chart. Just a note, 2024 is incomplete data, so for the next few slides after this, we're going to focus on 2023. As you can see, we're not just talking about a few transactions. It's quite a large volume, and in 2021, which was a good year for the industry, it looks like approximately 700,000 transactions would have fallen under this rule had it been enacted. That's approximately 11% of all transactions, which is quite a bit. In 2023, there were an estimated 495,000 transactions, and about 12% of all transactions that met the FinCEN definition of this rule. This chart breaks it down further by state in 2023. Again, left side is number in thousands of transactions. Right side is percentage of total transactions in those state, with the yellow line representing that percentage that you can see on the right. What sticks out immediately is we have Florida, California, North Carolina, Arizona, large volumes. Again, this makes sense. Well, California, not so much, but Florida, California, Florida, North Carolina, Arizona are big areas where people are moving towards. Florida in 2023 had about 62,000 transactions that would have been reportable. That represents about 17% of all the transactions in Florida. For California, it's 40,000 transactions, and again, about the same percentage. And there's a lot of entity and trust creation for property purchases in those states. So, on one hand, you go down the left, you can see Utah, Idaho, the first 10 states have very little volume. I don't know if there will be an increase or not, but in 2023, if this rule was enacted, very few transactions in those states would have qualified. Hawaii is interesting all the way on the right. It's 2 or 3 thousand transactions, but that represents a whopping 25% of all their transactions meet the criteria of this rule. These are the core-based statistical areas in its geographic area encompassing a metropolitan or micropolitan statistical area. So this is defined by the U.S. Office of Management and Budget, and it's for federal agencies collecting and publishing data. Basically, it's the nation's largest population centers. Again, agent sales meet the criteria, except this time it's on the right-hand side. The percentage is on the left, represented again by that yellow line. So you see, we've got Phoenix, Atlanta, Chicago, New York, obviously, Tampa, and these are all population areas with a high volume, relatively high percentage transactions that would have qualified. Again, on the left, you can see all those areas in Texas are very low, which is actually a little bit surprising with the Dallas area being down there. And then finally, 2023 by price range. The left-hand side, cash sales in thousands, right side, percentage. Now, this part I think is actually very interesting. You can see those first 3 bars on the left. Those first 3 bars on the left, it's approximately around 190,000 transactions that would be reportable under this new rule. None of these would have been reportable under the old GTOs because they are under $300,000 unless Baltimore is included there. But we can safely say pretty much none of these would have been included in the old GTOs. So this rule, along with bringing in all the other states, is increasing the number of reportable transactions considerably. Then you can see on the left, as people's wealth increases, so do the instances of trusts and entity formations. All right, let's talk about quickly. We have about 2 minutes. I want to talk about the risks of non-compliance. FinCEN anticipates the cost of this rule to our industry to be about $428 million to $690 million in the first year, between 401 and 663 in subsequent years. FinCEN estimates, again, about 2 hours, 75 minutes for initial training, 30 minutes for annual refresher training, which equates to 51 million for initial training for industry and 23 to 31 million in subsequent. And they also estimate 2 hours or 2.5 hours per reportable transaction to collect and review transferee and transfer specific reportable information. So 2 hours for that, and then 30 minutes to actually do the report. So again, 2.5 hours per reportable transaction. All right. The final rule, the rule itself does not set forth potential penalties for not filing reports or filing inaccurate reports. Rather, the penalties for reporting violations will track the general civil and criminal penalty regime for BSA reporting violations under 31 USC 5321 and 5322. So current civil penalties adjusted for inflation are $1,384 for each violation, up to $108,000 for a pattern of negligent activity, and up to $69,733 for each willful violation, or up to the amount involved in a willful violation not to exceed about $279,000. Criminal penalties can include 5 years of imprisonment and a criminal fine up to $250,000. So again, I'm going to send these to Diana so that everyone get them. These are the links to the real estate reporting rule, as well as frequently asked questions, which I encourage everybody to take a look at. And I want to thank everybody again for their time here. I know we're at 2. Diana, if we do want to go through a few questions, I'm fine with that.
I think we could go through a few questions on whatever we don't get to. I will send to Tony and I'll let him know who asked the question. So if you ask something anonymous that doesn't get answered, you could just shoot me an email. I did have a few questions about the cascade. Since this is an all cash transaction, there generally isn't a settlement agent because there's no loan. Who would be considered next in the cascade if there's no settlement agent?
So then let me go back. Okay. So if there's a settlement statement preparer, that would be number 2. And then if there's nobody doing this preparation of the settlement statement, that's where you get to the deed filer, which is whoever's being asked to file the deed, which a lot of times judicial would be doing.
Right. And then as far as co-ops goes, somebody wanted to know if the transfer agent would be in that cascade.
I am not sure. We don't deal a lot with co-ops. I can definitely look into that one. So, Diana, if you want to mark that as one for me to get back to, I'm happy to look into it.
Sure. A couple of people also asked if an attorney signs as an authorized signatory for an LLC, would they have to provide all the details you mentioned for the attorney?
Yes, if they are the authorized signer.
Okay. Sorry, I'm just want to try to go through all of the dismissing the ones that we got to. Um, if there's a transfer in a trust, we had a few questions about trust.
Okay.
One, if it's going into a trust without consideration, is that always exempt?
So no, not always exempt. The husband and wife into a trust is I I feel like that might be the only one that was
So if
exempt.
you're transferring it into a trust where you're naming other
Yeah,
people, that would
yeah,
be.
correct.
And then if an inherited property is then transferred into an LLC, would they have to report?
Yes. If I'm getting it from the estate, if I'm getting my inheritance from which is a piece of property from my great great grandfather, and it's coming to me. That's a deed from the estate to me is not reportable, even if it's for no consideration. If I then want to put it into
I
an
know.
LLC,
Mhm.
yes, that could be a reportable transaction.
Will this information be discoverable by the public, or is it
It,
protected?
it should be protected. It's the same way as a confidential informant. This is not subject to like if you file one of those FOIL requests. Like you can't if I sell my property or if I'm transferring deed to my sister and because it falls under that, I have to fill out my information and my sister's information. You can't file a FOIL request to figure out my information.
And a few people were asking about title companies doing this. Um, we will be
Yeah,
doing it. Well, it'll be a fee, but we're going to require the information to be given to us similarly to if you do ACRIS or PrEP.
yeah,
You fill out a form and you give it to us because you're the ones in touch with your clients, right? We're not going to know that information. But once you sign that designation agreement to us, we're on the hook now. So
yeah.
we took your information. It can come back to you. You signed it over to us. Now it's in our hands. And there are going to probably be some companies who decide that they want to do this, but if they're not in the reporting cascade and you decide to let somebody else do it, it will come back to you. You're still on the
Yes.
hook.
That's important to note because there will be third party organizations that set up as a service providing this information. And Diana's right. You can designate to them to handle it and to fill those forms out for you. But in the cascade, you are still the reporting person, even though they are handling it for you. It's different from when you file a designation agreement between parties in the waterfall. So, like Diana said, you file a designation agreement with judicial. Judicial is now on the hook. They are the person filing it. They are the ones responsible for it. If you delegate is the better way, not designate. If you
Right.
delegate to a third party your responsibilities as the person in the waterfall, you are still ultimately the reporting person. Or you're the person responsible.
Right. So I think we got to most of the questions that were asked more than once. If we didn't get to something, shoot me an email. I'll send it over to Tony. He said he'd be happy to get back to you. Thank you again. It was a great CLE. I know we're going to have a lot more questions. In the coming weeks, we will absolutely be sending out some additional information as we get it. So like I said, any questions, reach out to me. We will be having another CLE in February. It will be 2 credits on ethics. So look out for the invitation on that one, and I will get everyone their certificates out by next week. So thanks again. Always great to have you, Tony.
Thank you, Diana, and thank you, Judicial, and thank you everybody for taking the time to join me today.